Good morning, everyone. I'd like to call the meeting to order and acknowledge that we're in Treaty 1 territory, the home and traditional lands of Anishinaabe, Ojibwe, Innu Cree, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. My name is Neil Harden. I'm chairing today's panel. With me via Zoom is Diane Knight, and in the room is Robert Kraus. The assessor today is Justin Mikulik, and the administrative personnel is Phoebe Graywood. To the Zoom participants of the hearing, please note you are placed in the waiting room until your property is called upon. When it is your turn, you will be admitted into the meeting. Kindly follow along in the City of Winnipeg's Border Revision YouTube channel for the hearing process. Once the host admits you into the hearing, please close and mute your YouTube player. You will then be permitted to speak with respect to your property. Once your hearing has concluded, you can leave the meeting. We will be hearing applications for revision of the assessment rule in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the board. The board is appointed annually by council and is independent of it and the city administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order to be mailed to all parties as soon as possible. Please note that the board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony followed by questions that the applicant may have, then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the board will deliberate in private and make its decisions. You will receive the board's order by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We will be hearing items 2 through 4 and 8 on our docket today. Ms. Graywood, please affirm the assessor's and the applicant's testimony.
All right, Mr. Mikulik, please state your full name.
Justin Mikulik.
Do you affirm the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Thank you. Mr. Horsberg, can you state your full name?
Carson Horsborough.
Do you affirm the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Okay, the first item today is 1650 Leela Avenue. I understand there's 3 points of appeal. So, Mr. Mikulik, can you give us the initial information, and then we'll deal with the classification and liability.
Okay, so we have file number 24901, roll number 050094300570. Roll year 2025, assessed value 10,359,000, classification 20, and liability is taxable. I do have a recommendation for this property. Did we want to touch on that first?
No, we will deal with classification and liability first. So, Mr. Horsborough, on classification and liability.
Yes, I directed my administrative assistant to withdraw the classification and liability. I'm not sure if that paperwork has been sent over yet, but we're only disputing the assessed value.
Okay. Note that down. All right. Then Mr. Mikulik on the valuation then.
So I proposed a revision to 9,412,000. As you could see, using the 4.7 cap rate and net operating income of 442,345.
Okay. And I guess how was that NOI arrived at?
Yeah, so if you go down to page 9 of my brief, I had adjusted the expenses and that came up with the new net operating income.
Okay. Thank you very much. Uh, Mr. Horsborough, how do you feel about the recommendation?
Unfortunately, I wouldn't have time to contact my client to discuss the offer with him. So unfortunately, we aren't able to accept the recommendation.
Okay. So then, Mr. Mikulik, is there anything you wish to add on your presentation on
Yeah.
value?
So just having reviewed Carson's information, would you agree to the NOI that our NOIs had looked almost identical?
I believe, yeah, we are in agreement as it pertains to the net operating income. We feel that the capitalization rate is too low, and I will speak to that later.
Okay.
Okay, so Mr. Mikulik, then if you can elaborate a bit on the cap rate.
Okay, perfect. Okay, so just rolling on then. Um, since we are in agreement with NOI, I'll just touch here on the property description. So we have a 2021 build. It's a new build. They are row houses. There's 39 suites. You could see that you'll see in my pictures going on, each pad has a garage and then parking space behind the garage. Now you could see just going forward, page 2, just where it's located. So it's located by Leland North Community School, kind of in the Maples, Leland North neighborhood. It's a good area, mostly all residential surrounding it. Being 1650 Leela, it's right on bus routes. So owners have access to ease of access for public transportation. We can skip over page 3 and 4 as that's all income related. If we go down to capitalization rates, we're at 4.7 on this property. You could see on page 5 where the multifamily area comes in. So you could see where the city of Winnipeg comes in for cap rate between the 20th and 80th percentile, and then compared to other real estate brokers where they would come in with their cap rates. And then capitalization rate evidence on page 6. These are a batch of sales that have been stabilized for historical net operating income relative to the sale price. And so you could see the gap of cap rates of it lies from say 3.46 on the low end up to 5.65. For the purpose today, we're dealing with new construction, 2390 McPhillips, sold in 2020 with a stabilized cap rate of 4.7%. So we feel that based on the new construction sales, that 4.7 cap rate is perfectly applicable to this type of property. When we see here, if you want to scroll down to the pictures, page 10, I mean, it just gives you an idea. It's nicely landscaped, new build again. You could see that people have their own parking garage, they have their own driveway, they get their own waste pickup. And I couldn't get any interior pictures. There was none on the website. The property has low vacancy. You get your own deck off the back. You get a full basement. And then page 12, you could just see that we have various amenities I have posted that the property offers. So you get an open concept with the built-in sink dishwasher, kind of overlooking the living room space, stainless steel appliances, 1.5 bathrooms, in-suite laundry, obviously, full unfinished basement, energy efficient, forced air, central AC. So you're getting a lot of really good amenities at this place that you normally wouldn't get in a regular apartment, and it's all brand new. So and then you could see they have reasons to rent at Leela Landing. So located in the Maples, right next to all essential amenities, safe, family-friendly community, family-owned, professionally managed, high quality and experienced staffs to assist you. So you're getting all the care you need. You don't have to do any maintenance. And so when you're looking at it from that aspect, it should carry a lower cap rate based on the risk of the investment is on the better side, being that it is brand new, it's high demand in a good neighborhood. So 4.7% cap rate with the adjusted net operating income for our new value of 9,412,000 we feel is appropriate, and that would conclude my presentation.
Okay, questions, Mr. Hosborough?
Thank you, Mr. Chair. I have several questions. If we could look back on page 5 of the assessor's brief, we have in the chart the multifamily. It appears that of all the cap rate studies done by Colliers, CBRE, only one of them has pointed to a cap rate below 4.75, and it's low-rise A. Everyone else seems to have pointed to 4.75 to as high as 5.75. So I just wanted to ask the assessor, has any consideration been given to the fact that this property is a townhouse rental as opposed to your typical apartment rental?
Absolutely. We see that the townhouse rentals have as much demand and low risk as some of these other properties that would be high rises.
Okay, and if we move on to page 6, looking at the city's cap rate evidence, are any of these sales from townhouse rentals, or are all these apartment buildings?
These are apartment buildings.
Okay, so do you have any cap rate support for townhouse properties included in your evidence?
We had felt that the apartment properties would still reflect a reasonable cap rate for townhouse properties.
Okay, so the cap rate evidence in your brief, none of it is townhouse, correct?
That's correct.
Thank you. Just a few more questions. Regarding the sale of 2930 McPhillips, the city's calculated a cap rate of 4.71%. Are you aware if the property had typical market rents, or did it have below market rents when it was sold?
We're aware of the income that was reported at the sale date.
Would you consider that to be below market rental rates?
I haven't researched that.
So my understanding is if the property had sold with at market rental rates, the cap rate would have been higher. Would that be correct?
Not necessarily.
So it seems that the capitalization rate applied for this property, the 4.7%, it's based solely on one sale of an apartment building that has more than double the units, and it's not a townhouse. So I would suggest to the board that they don't rely on this one sale to justify the cap rate for the subject property. And thank you. That's all.
All right. Ms. Knight, any questions?
Just back to that cap rate. So the chart on page, I'm just trying to get there now. The chart on page 5 shows the high rise, low rise, all 4.75 to 5.5. How do you get to 4.70?
Well, because with the model, that's just the 20th to 80th percentile that
Right,
we,
yeah, okay, I
right?
understand that, yeah.
So you're still gonna have some that are gonna be below that. And regarding this property, I mean, it is a new build. It's in a good area. There's high demand with low vacancy. So, I mean, it should have a lower cap rate applied. And then when you look at the reconciliation of value with that type of cap rate, 265,000 a suite. Will be slightly lower with my new recommendation, but even if it's say 250,000 a unit, I mean, you can look at this type of complex and just ask yourself, like, does 250,000 a unit seem reasonable? I would say yes. So when you look at the cap rate reconciled with the market value per suite, I see that there really shouldn't be an issue from a total value standpoint.
Okay, thank you.
Okay, Mr. Kraus, any questions?
No, everything was answered. Thank you.
Okay, and I have no questions that haven't been asked and answered. So, Mr. Horsburgh, you can begin your presentation.
Thank you, Mr. Chair. So just reiterating, we're dealing with file number 24-901, 1650 Layla Avenue. If we move to page 3 of my disclosure, we are discussing a 39-unit row house multifamily property. And the city's assessment of $10,359,000 is incorrect as per our valuation of the property. The requested assessment amount is just slightly lower at $8,038,000. So if we move to page 6 of my disclosure, we have the city's income valuation of the property, and we have MNP's valuation of the property. The assessor and I are in agreement as it pertains to the net operating income, approximately $442,000. However, we are disputing the 4.7% capitalization rate. We don't feel that it is supported by market sales, and we don't feel that it's supported by market evidence. We feel that the capitalization rate of 5.5% is supported by market evidence. And I'll continue with my presentation here. If we go to page 7, we just have an aerial photograph and the assessment map of the property. Carrying on to page 9, just have a discussion as to the capitalization rate. Independent third parties and national real estate firms, Colliers International and Cushman & Wakefield, have analyzed market data, and their determination was that capitalization rates ranged from 5 to 6% as of April 1st. I think it's April 1st, 2023. I think it's worth noting that on April 1st, 2023, if you took, say, $10 million and put it into a guaranteed investment certificate, you could get a guaranteed rate of return of 5%. So the idea that anyone would be investing in real estate and expecting a 4.7% return, it's just out of line with the investment market. No one would be willing to take on the risk of a real estate development for a 4.7% return on their capital invested, when you could have a guaranteed 5% return with zero risk. So in our opinion, there really isn't any market evidence to support any sort of a capitalization rate below 5%. No one in the market would invest if you were getting less than a 5% rate of return. So that's just another reason why we can't wrap our heads around below 5% cap rate. It is just totally out of line with the market as of April 1st, 2023. And if we move on to page 10 of my disclosure, it's just a little more information on how the assessor and I came to agree on the net operating income. These are the actual expenses that the property had incurred. So we can see the actual and the revised expense workup. Of course, we have removed amortization and mortgage interest from the equation. And then if we move on to page 6, again, we just have the income valuation of the property with the revised net operating income of approximately $442,000, and then the 5.5% cap rate, which is supported by independent third-party market studies. And if you bear with me for just 1 second, I believe it's page. Yeah, if we go to page 30, let's give everyone a moment to go to page 30 of the disclosure. So on page 30, we have the information provided by Colliers International as it pertains to capitalization rates. So looking at low-rise multifamily buildings, it was determined by these third parties that capitalization rates ranged from 5 to 6% as of April 1st, 2023. So again, there isn't any market evidence that supports a 4.7% capitalization rate. We do feel that the 5.5% capitalization rate that we're requesting is supported by market evidence and the reality of the investment market on April 1st, 2023. And that would conclude my presentation. Thank you very much.
All right. Questions, Mr. Mikulik?
Yeah, so just going to page 9, I guess, where you have the valuation side and the capitalization rate. When you talk about the investment time frame at April 1st, 2023, when someone buys a real estate investment, especially of this type of magnitude, would you agree that they tend to hold that for long periods of time, longer than when they would buy, say, an investment of a bond?
No, not necessarily. I wouldn't agree with that. You just pointed in your evidence that someone built a multifamily building and then sold it shortly after. So I would say, looking at sales throughout the market, some people build to hold, some people build to sell. I'm not going to speculate, but in my experience, people do both.
Okay. And then, so further to that point, then would you agree, though, that there's a lot more volatility in the quote unquote investment market and not being real estate?
No, again, I wouldn't agree with that. As I said earlier, you could have had a guaranteed investment certificate with a guaranteed rate of return of 5%. And again, that's guaranteed. There is volatility and there's risk with investing in real estate. No one would be investing in real estate to get a 4.7% rate of return when you could have a guaranteed rate of return of 5% with zero risk. So no, Mr. Mikulik, I don't agree with you.
And then, so pointing out to these REIT-owned multifamily properties, are you suggesting that these sold for under 5%?
Looking at the 2390 McPhillips, it was purchased by a REIT, and it was purchased with below market rents. So they looked at it and they said, okay, if we increase the rates, rental rates to market, we're going to be getting more than a 4.7% return. And with a new property, there aren't any rent control. There's no rent control for 20 years. So they had ample time to increase the rental rates to market. So the 4.7% on that sale, it's just not reflective of the capitalization rates in the multifamily market.
So if you suggest that the 4.7% isn't reflective, would you not agree, though, that the new realized income, that owner wouldn't also sell it for that price that they paid? You would have to recapitalize that new income stream. Would you agree with that?
I'm not going to speculate on theoretical, if they did this, if they did that, if they did this, if they did that. It's not relevant to the market value of the subject property.
So I see here you have townhomes 140 and 160 Eaglewood and 85 Fiorentino Street and 30 El Tossi Drive. So did those properties sell?
Can you give the board and myself the page number you're looking at?
It's the same page we've been on, page 9, 5.1, capitalization rate, where you have the REIT-owned multifamily properties. You have 85 Fiorentino Street and El Tasi Drive that are townhomes. You have 140 and 160 Eaglewood Drive that are townhomes. Did those properties sell at a below 5% cap rate?
As far as I'm aware, those properties did not sell at a below 5% cap rate.
Okay, because you did outline in the table below, properties with sub 5% cap rates tend to be owned by real estate investment trusts or large institutional investors. So I'm just trying to wonder what's going on with the table here. Like, are those sales? Are they share transfers?
Just give me a moment here. The page isn't showing up for me here. Okay, I'm sorry about that. It was the table itself wasn't loading on my end, so I just had to reopen the PDF. So yeah, properties that have sold with below 5% capitalization rates, and I don't know for a fact that these properties did sell for a below 5% cap rate, but this is an example of some of the apartments and townhomes. You just look at the unit size. Like we're dealing with a subject property that has 39 units. It's not going to attract our real estate investment trust investor type. So if the property were to be assessed and looked at in the market with a 4.7% capitalization rate, the only people who are in that kind of market are large institutional investors and real estate investment trusts. They're the ones that can make those numbers work. So looking at properties that own large townhouse complexes and large apartment buildings, they're real estate investment trusts. They can make that number work. For a smaller 39 unit townhouse complex, there isn't a buyer in the market that could make a 4.7% capitalization rate work.
Is that speculation? Are you speculating on that now?
You asked me a question, Mr. Mikuluk, and I've answered it.
And you've speculated that a buyer would never do something like that, yet you've placed a chart that shows sub 5% that has townhomes in it. So I guess I'm just struggling to find where in a 3/4 point adjustment would be realized on this property.
I don't think you're understanding. The market that real estate investment trusts are investing in tends to be large properties. The property we're dealing with is a 39 unit townhouse complex.
And so, in your opinion, a 39 unit townhouse complex that has almost no vacancy would be a bad investment for a real estate investment trust?
If with a 4.7% rate of return, it would be a bad investment. You would need greater than that in order to justify the investment.
Have you provided any cap rate sales that would support the 5.5%?
I'm basing the 5.5% cap rate on the third party market studies, none of which have pointed to a 4.7 or 4.75% cap rate. all of them point to a minimum of 5% for the capitalization rate.
Okay, and then going to market studies, a company like Colliers, they determine their cap rates 1 year after the sale price. Are you aware of that?
Yes, I am aware.
Those are all my questions. Thank you.
All right, Mr. Kraus, any questions?
I have no questions, thank you.
Ms. Knight, any questions?
So on page 7, you have a picture of the property. And there's a whole bunch of the same similar properties in that picture around that. I think it's a church. I have no idea. Are they owned all by different companies or are they owned by the same company?
So yes, that is a church. And then, yeah, the aerial photograph on page 7, each of those buildings, that makes up the 39 units.
Right. So each of those buildings, all the totals 39 units. I got you now.
Yeah.
Okay. And the rest of my questions the adjuster asked and you answered already. Thank you.
Thank you.
Okay, I've got just one question. You put a lot of emphasis on the rate of return of a fixed rate investment. Um, April 1st, 2023 was the peak of the interest rate market. Would that be fair to say?
I would agree with that, yes.
And the 1 year rate of return was probably around 5%. At least that's what I got. But
Yeah.
um, uh, but when you're buying an investment like this, you're looking at a much longer term um, rate of return. Would that be fair to say as well?
It would depend on what the owner wants. In my experience, I have seen people purchase an asset and then hike the rents and then sell it, and they're able to sell it for a higher rate of return. So I would say generally people probably do tend to hold real estate assets for longer, but I wouldn't say it's uncommon to see a property change hands several times over the course of a couple of years.
All right. Thank you very much then. Is there any summation that either party wishes to do? Mr. Mikulik?
I just want to just touch on the element. Don't confuse rate of return with cap rate in real estate. Capitalization rate is supposed to define the element of risk towards the investment. And that's all I'll say. Thank you.
Okay, Mr. Horsborough.
Sure, I'd like to summate. Mr. Mikulik was smart to mention that the capitalization rate is a reflection of risk. And so, again, looking at what any investor could have had as a guaranteed rate of return of 5%, zero risk. Why would anyone want to invest in real estate with a sub 5% rate of return when there's a ton of risk? And that's all I'll say.
All right, thank you very much for your presentations. We'll move on to the next property, 102 Marlowe Court. So, can you swear the applicant in, Ms. Graywood?
Ms. Cates? Can I get you to state your full name?
Sarah Cates?
Do you affirm the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Thank you.
All right. Good morning, Ms. Cates. So on 102 Marlowe Court, Mr. Mikulik, you may begin.
We have file number 24-3059. Roll number 0500407300. Roll year 2025, assessed value 2,189,000. Classification T. Liability is G, as this is a grantable. It's a Manitoba Housing and Renewal Corporation. We have a 2-story row house. They're built in 1971. There's 20 suites. If you scroll down to page 2, you could see the location with the red teardrop would be in the Maples area by Shepherd Street and just north of Inkster. Area close to, again, public transportation and various amenities. Now, income value summary, you could see where the city comes in at for 23 bedrooms. We're applying an average monthly rent of $996.18. Our gross potential rents here are 239,083, so vacancy of 3%, effective gross income 231,911, expense ratio 53.75, factoring in that it is Manitoba housing, to get our net operating income of 107,259, 4.9 capitalization rate, and that comes up with the total value 2,189,000. On page 4, I've done a comparison of our rents to CMHC. So I have used the charts of row houses. So page 5, I had supplied the CMHC chart. And we're going to use the core area zones 1 to 4. And the area, the data says is very good. You could see October 22nd under the 3-bedroom plus. They do have it as a B. So it is very good data. Now, when you apply that back on page 4, I had did the work up here just to show you the market rent potential. If it was being realized at 1678, you would be at 402,720 for gross rent. Our model's coming in at 239,083, so we're only coming in at just under 60% of market rents. And again, this is to account for the Manitoba housing aspect of it, and along with the higher expense ratio as well, to come up with the total overall value. And that's how we also encapsulate that risk. We give it income that's a lot on the lower end to make up for the fact that, you know, you're not going to be realizing close to market income with a property like this. Now with capitalization rate, page 6, so you could see again where this falls along the baselines. 20th to 80th percentile between 4.75 to 5.45%. That's the 20th to 80th percentile. Of course, you can have some that are above and below that range. And it still falls in line with other industry brokers. Now, capitalization rate evidence on page 7. So these capitalization rates were calculated using stabilized net operating income of all these properties, historical stabilized net operating income. And you could see the ranges that we came up with. So based on where these ranges fall in line, we feel that that still supports the model cap of 4.9%. When you look at this batch of sales that we have stabilized. If you scroll down, I've just on page 9, I mean, I don't have any interior pictures and it's not one of the multifamilies that we have inspected recently. But you could just see where it's located. You could see the building's older. And again, I think we've accounted for the fact that this is an older building. It's going to run higher expenses. The income's 40% below market. So I think from an overall value standpoint, I still think the 4.9 capitalization rate is acceptable because the income is so low, to where it also reconciles with value per suite, 109,450, on the lower end of that range as well. So other than that, that's everything I have for my presentation. Thank you.
Okay, questions, Ms. Cates?
Yes, thank you. So for your income value summary on page 3, is the model accounting for the fact that it's social housing, or is it just accounting for the fact, or is it treating it, sorry, like it is a market apartment on the lower end of the rental range?
It treats it as market on the lower end.
Okay. And then looking at your cap rate table on page 6, do you have any information on the sales that are being used to achieve those ranges stated, such as the number of sales or the location of those properties?
Are you talking about page 7, the cap rate evidence, or the big city of Winnipeg chart? That
Yeah,
has
the big chart.
on page 6?
Yes, on page 6, like where you
Okay.
have your 4.75
Oh,
to
okay.
5.45.
Yeah, okay. So just regarding the sales, we provided that on page 7 to support the range of that capitalization rate.
So I guess just to clarify, there's sales that are going into achieving those ranges that you're saying are the 20th to 80th percentile. So do you know any of those sales and any of that sale information?
They're all the information we get through the department and we verify them. So that would go into creating those numbers.
Okay. And would you agree that a cap rate potentially beyond the 80th percentile would be for a riskier property?
Well, I used to, but sometimes I kind of look at the information that gets presented through cap rate evidence, and we're always trying to up the income, and I wonder, like, is it really about risk anymore? So I would say that I tend to lean no.
So in your opinion, is cap rate not at least in part measuring the risk?
It does to some degree, but I don't think it captures all of it.
Okay. And then in that third paragraph, it says the broker cap rates are stated to further support the assessment department cap rates. Is that correct?
That is correct.
And in looking at the subject, which would be a low rise B or potentially even lower, would you agree the brokers are suggesting a floor of 5% for those type of multifamily properties?
They are, however, I don't know if they have get all the sales that come through, if it's just sales through their brokerages, or like us, we get everything that comes through our department, so.
But based on what the brokers are saying, as the market rates and the subject is at a 4.9%, does that not strike you as being low?
I don't know what's gone into their calculation of their cap rates though, so what expense ratios are like, what income's like, so it's too hard to say.
But yet you still use them as support in your own briefs, do you not?
I think we have to, just by IAAO standards, to show that we're not way out of line.
Okay. And then your cap rate sales on page 7, you have not provided the workups as part of your direct evidence. Is that correct?
I have not, due to privacy concerns. We were instructed that we were not allowed.
Okay. That would conclude my questions for this property, and then I also have some rebuttal.
Okay, we will deal with rebuttal after we've done your main presentation. All right. So any questions, Ms. Knight?
Actually, she asked my question and it was answered. Thank you.
Okay, Mr. Kraus, any questions?
Yeah, with regards to, you were saying that you had adjusted the rent to compensate for, like you've got it at 60% of what the average market rent is. And that was your way of dealing with the social housing aspect of it. Is that correct? Am I understanding that correctly?
That's correct.
So you've kind of built in a bit of the risk there. Is that correct or no?
Yes, that is what I had touched on in the presentation, where we have a very low income and higher expenses to account for the true net operating income not being
Right.
realized.
But then you're still going with quite a low cap rate as well.
I would say that if you start going with a higher cap rate, you would have to start using market rents, because then you're really going to encapsulate the risk differently, right? It's all numbers based.
And then with your examples on page 7, are any of those manageable housing or are they just market?
They are market apartments because we don't have any Manitoba housing sales.
Right, okay. Okay, thank you.
Okay, now I've gotten a little confused here. Didn't you say that the rent applied was low end market?
Yeah, it's
Okay,
40% or
so
50%.
you are applying market rents then, are you not then?
Well, we're applying well below market rents by 40%.
But you said they're low end market. I mean, it's
Well,
either market or it's not
I
market,
mean,
right?
I don't like, yeah, like I guess if you just look at terminology, we're 40% below market. I mean, I don't know how else to.
Well, if you consider 40% below average, that's one thing, but there's certainly low end properties that are more geared towards people looking for affordability rather than luxury, right?
And that's what I'm saying. It's been reflected in that.
Okay. All right, Miss Katz, you can begin your presentation.
Okay, thank you. So if you turn to page 2 of my brief, we have a summary of some of the pertinent facts of the property, as well as our requested assessment of $1,788,000. If you go to page 6, we have our property maps. That includes an aerial map view of the property, as well as a Google map view to get a better sense of the neighborhood. And then on page 7, I've provided some exterior photographs of the property. So you could see that these do appear to be fairly worn, given their age, and there are quite a few buildings on the site. On page 9, we have our property description. So the subject property is located on Marlow Court, north of Inkster, at its intersection with Maple Glen Drive in the Maples area. The property consists of 5 two-story row house buildings, which were built in 1971. The land area is approximately 36,000 square feet. And there are 20 units, which are all 3 bedrooms, and there is surface parking available on the site. So if you scroll down to page 14, we have an overview of our income approach. So the NOI is not in dispute, but I just wanted to spend a couple moments discussing the rationale for how we get to the NOI. So in terms of the market rents, given that the subject property is social housing, it operates on a rent geared to income basis, meaning that the rents achieved are not deemed to be at market. So what they can based on a proportion of their income. So that could translate to like potentially even just $300 a month for these units. So when we're looking at the rent that we're applying close to $1,000 a month. So while I'm not suggesting that the current market rents or the current rents that they achieve are market, there is a considerable jump to get to that $1,000 a month. And in terms of how it connects to CMHC, we know that the CMHC rents are averages. We don't know the entirety of that range of the low end and the high end. Given that the subject is social housing with very basic utility grade finishes, it should be at that low end. So when the assessor is commenting on 40%, it's not necessarily 40% below market because we're dealing with the averages. And we know averages tend to be pulled up by newer developments or renovated developments. So using those rents, it's not actually 40% below. We're going to the low end of market. In terms of the vacancy, these properties don't achieve a market vacancy. So we're using 3% based on CMHC. And in terms of the expense allowance, 53.7% of EGI, I would suggest that this is not an expense allowance on the higher end of market. When we're looking at a typical apartment that's of this age group, you might expect an expense ratio at the high 40% to the mid 50% range, but that changes when we're looking at townhouse or row house style properties. There's wood frame, multiple buildings, and these do tend to have higher expense ratios. For market apartments that are well managed of this style of multi-building wood frame, it's not uncommon to see expense ratios actually getting closer to 60% or even a bit above that. So 53.7%, I would suggest, is well within the market range, maybe even a little bit low for the type of property. So what we're doing today to narrow the issues is, instead of using a higher expense ratio, we're going to capture all of that extra risk and extra cost in the cap rate. So if you turn to page 15, we have our cap rate overview. So when we're looking at social housing, these should not be valued just as market apartments. They are different from market apartments, and in our view, they're a distinct subset of the multifamily class of properties. So in terms of how we get to our social housing cap rates, we take guidance from Richard Poulton, who wrote the Valuation and Market Studies for Affordable Housing text for the Appraisal Institute. And he suggests that in order to get to an appropriate cap rate, we start at a market rate and then adjust for risk factors. Reason being because these properties don't tend to transact, and when they do, they tend to have atypical conditions associated. So in terms of what we would look at in risk factors, Poulton does break it down into a variety of more detailed factors, but realistically, they could be broken into 4 broad characteristics. So that would be whether the property has low cost or low quality construction, advanced age, declining neighborhood, and low income tenancy. Now, not every property has all factors, but all social housing properties do have low income tenancy. So if you go to page 17, we have a detailed overview of why we feel low income tenancy warrants an adjustment. But just to summarize that, the reason is because low income tenancy has a direct relationship with deferred maintenance. So these properties, they don't earn enough revenue to cover their operating expenses. So they need funding to keep them operational. And while they achieve that funding, there isn't sufficient amount of funds in order to do those preventative maintenance and repairs that market apartments would be able to do and would be incentivized to do. And what we see happening is that these issues build up over time in terms of the number, but also in terms of the severity of the issues as building systems start needing to overcompensate for other ones. And a pretty good case study of that is when looking at 185 Smith, which is a Manitoba housing tower that had a lot of issues with deferred maintenance. In 2015, it ended up flooding due to a broken water pipe and damaging several key systems. Even after putting $3 million into it, they were told that that wouldn't be enough. They would need another $20 million to bring it back up to standard. And we could see how this happens when we look at a 2017 news release. Manitoba Housing was talking about $500 million in deferred maintenance across their portfolio. And then when we compare that to how much funds the province actually allocates on an annual basis, it's not sufficient. And so these issues are a symptom of chronic underfunding of these properties over time. And another point that there is support from board orders to show that simply applying a lower end rent isn't enough to account for it being social housing. And in fact, what's required is not only a lower end rent and potentially higher expenses, but a higher cap rate. So if you turn to page 19, we have the overview of what we've done for the cap rate for this specific subject property. So we are disputing the assessor's cap rate of 4.9%. We feel this is far too low for this type of property. We're applying a cap rate of 6%. So we have our base cap rate of 5.5%, and then we've done a 0.5% risk premium to account for the type of construction, the low income tenancy, the condition that it appears to be kind of in a below average state from the exteriors. So I have also provided an independent cap rate study. So it is a separate document which gives more background information as to how we get to the base cap rates. So I'm hoping to just do a brief presentation on that.
Go
If
ahead.
that
That's
is
your
okay.
that's your Altus 2025 cap rate study.
Yes.
Okay, go ahead.
Okay. So in that separate Altus cap rate study document, if you turn to page 2.
Just a second, I just have to get that opened.
Okay, for sure.
On what page did you say? Sorry.
I'll just start on page 2.
Thank you.
Thank you. So on page 2, we have an overview, just some background on cap rates, but the important points from here is toward the middle of the page, it gives how you would derive a cap rate, where it says you would convert a single year's income into a value indication. As well, when you look toward the bottom of the page, it talks about the 3 items of a cap rate, which would be perceived risk, expectations for appreciation, and required return. So risk is a key component of the cap rate. If you turn to page 5, toward the middle, we have the entirety of the assessment cap rate ranges. So while most of the cap rates are stated to fall within the 4.75% to 5.45% range, the entirety of that range is 3.5% to 7.95%. So what I was trying to get at in questioning is that going beyond that 80th percentile, the city's own cap rates go up to 7.95%. So when we're dealing with social housing properties where there is significant risk, it would make sense to move beyond the 80th percentile. Additionally, when we look at the market reports that are below that, if we're looking at a low rise B, which again, I would suggest the subject might even be lower than that, they're not suggesting anything lower than a 5%. So to maintain a 4.9% cap rate for this property would be to suggest that this is one of the best investments in the city of Winnipeg. Now on page 6, we have some overall discussion on borrowing costs and interest rates. Now, the main takeaway from here is that if an investor could get a low risk government bond, which is very secure, with a 4.5% return, then using cap rates as evidence for real estate, for a real estate valuation, and we know real estate is a moderate to high risk investment, using cap rates sub 4.5% for these type of properties, it just logically doesn't make sense when they could get this type of investment at that same time. So when we're looking at these multifamily valuations at that point in time, I would caution against reliance on sub 4.5 cap rates, which the city has quite a few of. Now, if you go to page 9, we have some of the factors that we would look at in terms of potentially adjusting the cap rates. So not all factors would apply to all properties, but some that we'd be looking at today would be building type and construction, durability and quality of income, and condition. Now on page 11, we have our cap rate sales. So we have recently added a new cap rate at 150 Hendon, but you can see our ranges are from 5.26% to 7.11%. Now you'll recognize 150 Hendon. We have an alternate valuation workup than what the city has. They have a cap rate in the 4s, and just the kind of rationale for this new cap rate is that we have had discussions with the purchaser at the time of sale. They reasonably expected the rent to increase. the vendor had done some renovations to the property, and at the time of sale had advised them that they'd applied for above market increases. So when we're looking at a cap rate workup, it has to go beyond just a data entry of historical information. If at the time of sale, they would have reasonably expected to achieve a different income stream, then in order for that cap rate to be properly stabilized, we have to use that income stream and get into the mind of the purchaser. So this is how we have our 5.42%. Now, if you turn to page 12, we have a breakdown of sale price per suite. This, but given that we're not doing direct comparison today, I would not use these price per unit as a direct measure for the valuations today. And that would conclude my cap rate presentation. Now I'll just tie this up with the main brief. So if you go back to my main brief to page 21, we have our valuation breakdown. So we're using a net operating income of $107,259 and a 6% cap rate, which gives a value of $1,788,000 rounded. Now in the appendix, which starts on page 23, I've included the city valuation workup, as well as just some additional text regarding our position on social housing. And that would conclude my presentation on this property. Thank you.
Okay, questions, Mr. Mikulik?
Okay, questions regarding the actual property first. Okay, you know what? Would I be able to just go into, since they agree with our net operating income, I have cap rate rebuttal to dispute their cap rate. Would we be able to speak to that?
We will deal, I believe the applicant has a rebuttal here as well, do you not?
Do.
Okay, so we'll do questions on their main, the applicant's main presentation, then we'll have the applicant's rebuttal, and then your rebuttal.
Okay, so just regarding this property, I'll just say no questions.
Okay, Mr. Kraus, questions on the applicant's main brief?
No questions. Thank you.
Ms. Knight?
I'll wait till they make their rebuttals.
All right, so Ms. Katz, your rebuttal then.
Is it on our thing?
Has been distributed, yes.
Pardon me?
It has been distributed. It should be in your folder.
Let me see, item 3. Okay, this is the Altus
31 pages?
Yes.
Okay, thank you.
May I begin?
Yes, you can begin. I have it.
Okay, perfect. So if you turn to page 2, we've included the overview of the city's cap rates. And again, just to reiterate this point of sub 4.5 cap rates, it really just does not logically make sense given what we know about the interest rates at that time period of our reference date. So I would suggest using significant caution when relying on these cap rates or not relying on them at all. On page 4, we've recalculated the cap rate for 459 Sargent. So when we look at what MLS is saying, they suggest an annual gross income of $101,142. But then they're also suggesting an average rent of $740 per month. So based on this rent that they're suggesting, this is what a purchaser would expect to achieve when they purchase the property. So while this is different than the historical income, this is what they would anticipate. And an important part of cap rate calculations is the principle of anticipation and what can we expect to come. Now, historical information is good, but when we have information about the future state that speaks to the contrary, then we have to use the future information, because using the historical that's not the income stream that they were purchasing. And when we do this recalculation, we get a cap rate of 5.79%. So on page 5, I've provided our workup for this. So our expenses are what the city was using for expenses. Now, while they don't release their workups as part of their direct evidence, we had obtained these expenses through some of their prior rebuttal. If you go to page 7, 150 Hendon, now that this is in our cap rate study, we'll take this out of our rebuttal, but it's in there just because it is fairly new. So again, what the income stream that the purchaser could expect to achieve is different than the historical income. This is based on information that the vendor had told them that they had applied for rent increases based on renovations to the property. So they could reasonably expect to achieve these higher rents. And this is this is supported by the fact that, so they purchased it in mid-2021. Now, at the end of 2021, they said that they expect a gross potential rent of $712,182, which works out to $1,006 per unit per month. And then in their first full year of operation in 2022, they achieved a very similar figure, which supports this line of reasoning here. So in recalculating that cap rate, we have a value of 5.42%, whereas for both of these properties, the city is in the 4% range. And we have our workup on page 8, as well as some supporting documentation of the, the sample RTB orders, as well as the mailers that we've used. And then on page 19, we've also rebutted some of the older cap rates that the city had used from the prior cycle they've carried through. So the background on 700 St. Mary's and 32 Arden is based on an intention to renovate, but given that those are older cap rates, I won't go through those in detail.
I think we lost
That would
you.
conclude. Sorry,
Yeah.
are we good?
You're kind of breaking up there. Could you go back a little bit? You were just dealing with the, I guess the later material.
For sure. So I just said that on page 19, we also have some rebuttal on their older cap rates for 700 St. Mary's and 32 Arden. But given that those are older cap rates, I won't go through those, but those are just based on an intention to renovate. And so I have that starting on page 19 for the board's review. But that would conclude my rebuttal presentation on the city's cap rates. Thank you.
Okay, Mr. Mikula, questions on the rebuttal?
Yeah, just so regarding the, say on like page 5, where you talk about 459 Sargent, is it fair to say that if a buyer is realizing added income towards the property, that they would not sell it for the same price that they paid for it?
I don't know if I follow the question.
So by adding the income to the new apparent principle of anticipation income stream, would there not be a new value realized because there's an increase in income? Thus, the buyer wouldn't necessarily sell it for what they paid because now they're making more money.
Well, when we're doing cap rate calculations, like the sale price is a constant. So this is what they paid based on the income that they could expect to achieve. What they would do with the property in the future remains a question mark, but they did pay $1 million based on the income that was given to them by the broker information.
Okay, so are in your experience, are assessments done based on principle of anticipation? Or are they based on historical income that's been reported on the property when you're talking about a subject assessment?
Well, when we're looking at assessments, we have a reference date to
Okay.
use in terms of the background of the assessments.
Okay.
I'm not sure, but I know that when properties are renovated, for example, the city will look forward at future income and make changes that way. So,
Sorry, we would look for forward income based on what? I'm just struggling to follow that.
so even in cases where we have our reference date of information, if the city has reasonable information that the property has been renovated, then they'll look forward to what those higher rents might be. So, I mean, whether principle of anticipation is a part of assessments, I'm not sure of the background of all of your assessments, but principle of anticipation is part of real estate valuation.
Okay, so in your experience, though, a lot of your subject properties that you bring forward for appeal, you've done 3-year historical net operating stabilizations, is that correct?
Yes, yeah, we do 3-year historical stabilizations for our valuations.
Okay, so you wouldn't necessarily be doing any projecting then, similar to like what they did on this sale? You would never look forward and say, well, they're below market, so here's what we can realize on the value. You would like, is that something you would do for a subject property?
In terms of adjusting
The income
rents.
higher?
Well, it's a bit of a different situation because I'm not like I said in my presentation, the historical information can be good unless we expect something to change. So when we're doing our reviews in terms of what to appeal, we will look at those things. But in terms of what you see at the appeal level, there is a bit of a selection bias there because we don't appeal every property that we look at.
So would you agree then that we're not necessarily comparing apples to apples if assessments are based on historical and these sales are based on future realized income?
I don't agree. I don't agree with that. What you're doing with assessments, you're coming up with a value at the reference date. Cap rates, it has to go beyond a simple data entry. Like you have to have a stabilized income stream when you're trying to gauge what the proper cap rate is.
Those are all my questions.
Okay, Ms. Knight, any questions on the rebuttal?
My question was asked and answered. Thank you.
Mr. Kraus?
No questions at this time.
All right, I guess I just have a feeling a bit uneasy about the idea of using what a vendor says his property might generate in terms of income to calculate a cap rate. Vendors tend to put their properties in the best possible light. That doesn't mean, I think, that we can base a cap rate on that. Is that not so?
Based on 459 Sergeant with the MLS like broker information or
Well, when you're selling a property and the vendor says, well, you can achieve this much in terms of income, again, that's 459 Sergeant, you're right. But I mean, the vendor puts his property in the best possible light, and is that anything more than a sales pitch?
so what I would say is in terms of broker information stuff on MLS, like it is marketing material at the end of the day, so they will want to shed a positive light, but at the same time there are also professional ethics that brokers follow, and so they can't say that you're going to achieve an income stream that's completely out of reach. There has to be a basis for the statements that they're making. So in our view, broker information is seen as a form of reliable information to use.
All right. Okay, now, Mr. Mikulik, you have a rebuttal, you said?
Yes,
All right, let's, is that in our,
it
There's-
should be. I
yesterday
sent
at
it
9?
yesterday.
Yeah,
I did send it yesterday.
uh, yesterday at
3 something.
4:12? Is that the one that was sent at 4:12? Let me open it and see.
It'll
No,
say item
that's the Altus.
3059, ENT rebuttal. In your SharePoint folder.
Okay, I've got it. Is that the one labeled City of Winnipeg rebuttal to Altus cap rate sales?
Yes.
11 pages? Okay. We have that, I guess. Does everybody have it open?
Yeah.
Okay, proceed then.
Okay, so just to touch on the point I had also made prior is our assessments are all based on historical information. So when we come up to a certain reference date, we're taking everything that a property has reported to us. I don't think it would be fair if we started going towards properties and saying like, well, they're X amount below market, so if it's sold, I can realize another 20% on the income, right? So I just want to make that clear in rebutting the cap rate study. And then as we go through it, you'll see that on page 1, so we have sales 1 to 3. Sales 1 to 3 have 1 year income and expense information, which is insufficient to calculate a stabilized net operating income. And again, that circles back to, our assessments are based on historicals. They report to us yearly the income and expense information. When an applicant is at the board appealing a subject property, they are basing it on prior historical information to calculate a value. So these sales 1 to 3, you could see that 345 Talbot on page 2. So there's 1 year of income and expense information, and then the Altus calculations of average rent levels are inconsistent with rents reported in the prior year. So if you look at what they've reported to us on an income and expense, you could see the total income was 235,294, yet 274,000 Altus has used for their income, that was not reported data to us. 677 Maryland, again, 1 year of income and expense information only, and Altus's calculation of average rent levels are inconsistent with rents reported in the prior year. If you want to look at here, the residential rent, you could see comes out to 169,816. The property has very high vacancy as well. So it's in our mind again, when we talk about historical reporting of information, that this property would be very difficult to use in terms of a sound cap rate analysis. Sale number 3, 738 St. Mary's, again, we say is unusable due to the calculation of average rent levels are inconsistent with rents reported the prior year. So on page 7, the rental income is 106,827, and Altus has used a higher income at 143,634. And then just scrolling on further, if you want to look at 100 Maryland, there is no actual data that's been reported at all on that sale. It was purely based on realtor performa, and I don't know, quite frankly, what else. 2390 McPhillips, page 10. So you could see that Alta's calculations of average rent levels are inconsistent with rent report in the prior year. So again, you could see the 3-year stabilization that was done. And then the increase added on to capture a new cap rate. But again, that circles back to if a buyer is realizing this new income that's going to be gained after the sale, are they really selling it for that same sale price? And so that new income and expenses has to be recapitalized again on a new value basis at market cap rates. So that would conclude my rebuttal. Thank you.
Okay, questions on the rebuttal, Ms. Katz?
Just a couple, thank you. So in regards to your comments on sales 1 to 3, given that there's 1 year of income and expense, to be clear, there's no IAAO standard and there's nothing in appraisal theory suggesting that 1 year can't be stabilized. That would simply be the assessment department's opinion. Is that fair?
I would say that it's the assessment department's directive to do things on the basis of how the assessments are created. So we have to stay consistent with assessments are created based on historical reporting of information.
Assessments aren't necessarily created on 3 years of stabilized income and expenses, correct? Like the assessments are all modeled and there's a lack of certainty as to what they're based on.
When owners report their income and expense information to us, that gets entered into our system so that we can derive our model. So we're using the data that gets reported yearly from all the properties in building the model.
Okay, and then regarding your comments on a different sale price, when you're calculating a cap rate, the sale has already happened, so the sale price is a constant. Is that correct?
I disagree.
You disagree that the sale price is already set and is a constant?
I agree with the fact that the sale price would be different based on the new income stream and expenses that get stabilized after the sale.
Okay, I'll just leave it there. Thank you. That would conclude my questions.
Okay, Ms. Knight, any questions on the assessor's rebuttal?
No, my question was asked and answered.
Okay, Mr. Kraus?
No questions, thank you.
All right, does either party wish a summation on this property then?
I have no summation.
Ms. Katz?
I'll just do a brief summation. Our position on social housing is that they are different. They should be valued different. And we are very transparent in all of our data provided and all of our background calculations. So I feel that more weight should be put on our evidence as we've done more of a site-specific analysis for this property. Thank you.
All right, thank you very much. That concludes this property. We'll take a break until 10:35 and then come back into session for the last two properties. All right, welcome back. Next property that we're doing is 2 Marlow Court. So, Mr. McCulloch, you can begin.
Okay, we have file number 243057, roll number 05004074474400. Roll year 2025, assessed value 7,235,000, classification 20, liability is G, grantable. This is another Manitoba housing property. We have a 10 building, 2-story row house, built in 2019, so it's newer. Number of suites, there's 40. If we go down to the location, basically down the street from the prior one we had just talked about at 102 Marlow. Going to page 3, our income value summary. So you could see they're all 4-bedroom units. Average monthly rent $1445.81, being that they are 4-bedroom. They are typically rented to more of the family as opposed to single individuals. So you could see our workup, the gross rents come out to 693, 989, vacancy 3%, effective gross income 673, 169, expenses 48.95% with a net operating income of 343, 653. And again, like Manitoba Housing doesn't report any income and expenses to us, so we kind of just have to go by that we've already factored in lower rents and higher expenses, and 48.95 is on the higher end for new construction. You're typically gonna see expense ratios that are running in the below 40% range on for-profit. Now, if you look at the CMHC market rent comparison again, so you could see we're coming in at 86.16%, being that it is newer construction and newer units. You could see on page 5 that table, it's the same table used, so core area zones 1 to 4 comes into the 3-bedroom plus 1678 with a very good quality in terms of data reporting towards CMHC. Now, capitalization rates, we had already touched on again. I don't think I need to touch on it again, just where the city of Winnipeg's cap rate is on the 20th to 80th percentile. And we've touched on our capitalization rate evidence, which we feel has been reported through solid data reporting to us. Now, I had just attached, I was only able to get a street view picture really. So just this gives you an idea here of what the building looks like. Having built in 2019, you could see that it is a little bit newer. And I know it used to be Manitoba Housing prior to that, but it was older buildings similar to what the prior one we talked about. That's what they kind of looked like before. So this is them in the newer state, but we haven't inspected this one, so I don't have any interior pictures, unfortunately. But outside of that, that would conclude my presentation. Thank you.
Okay, questions, Ms. Katz?
Given that the issues are the same as the prior property, I don't have any new questions for the assessor. Thank you.
All right. Questions, Ms. Knight?
No, thank you.
Mr. Kraus?
No questions, thank you.
Okay, then you can proceed on your presentation.
Okay, thank you. So if you turn to page 2 of the brief, we have our requested assessment of $6,248,000. On page 6, we have our property maps, so the aerial map view, so you could see all the 10 buildings, as well as the Google map view showing where it is in the neighborhood. And then on page 7, you could see some exterior photos of the current property. And then on page 8, I've provided some photos of the prior property, which was demolished. So this really speaks to the life cycle of these social housing properties. At a certain point, Manitoba Housing has to make a decision as to whether it's worth continuing to invest into the properties, whereas in this case, they've decided it was not worthwhile, likely due to all the deferred maintenance and other issues, and it actually made more sense to start over again. So this really speaks to those issues. If you go to page 9, we have our property description. So the subject property is on Marlowe Court. It is between the intersections of Shepherd and Fife in the Maples. There are 10 buildings, and the units are larger. They are 4 bedrooms, and there are 40 units, and there is surface parking available. So if you go to page 14, we have the overview of our income approach. So we're not disputing the NOI, but I've put all those figures here for your review. On page 15, we have our cap rate for social housing overview. So it'll be the exact same points as the prior property, so I won't repeat those, but I would just echo all of those arguments and ask that they be applied to this property as well. So if you go to page 19, we have our cap rate for this subject property. So we are disputing the cap rate of 4.75. We're applying a cap rate of 5.5%. Given that the property is newer, we're applying a much lower cap rate than what we would normally apply for social housing. So the points for adjustments would primarily be the type of construction. There are 10 buildings. We know that this is going to deteriorate at a faster rate than a standard apartment, as well as still is social housing. So we feel going to a 5.5 is a modest adjustment and makes sense for the property. So if you go to page 20, we have our valuation breakdown. So with the net operating income of $343,653 and a 5.5% cap rate, we have a indicated value of $6,248,000. And I guess a point of clarification, it's not that Manitoba Housing doesn't submit statements, but given that there are so many properties, they tend to categorize things in terms of project groups. So that is the issue in terms of their statements. It's hard to break those out, but they do kind of submit this information kind of in a bulk format to the city. So that would conclude my presentation on this property. Thank you.
Okay, questions, Mr. Mikulik?
I just want to clarify that we had nothing submitted to us from Manitoba Housing for this cycle. So just to clear that end up. Outside of that, you know what? I have no questions. Thank you.
Okay, and Mr. Kraus, questions?
No questions. It's not, thank you.
Ms. Knight?
No, thank you.
Okay, let's move on to our last property then on 15 Primac. We'll completely change the area end of the city here. We'll move to Transcona. Can
There's
you,
a new, I think there's a new appellant.
yes, there is. We're going to have to swear him in, yes. I was just about to say that.
Okay.
Ms. Graber, can you do the swearing in?
Mr. Newman. Thank you. Do you affirm the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
All right. Okay, Mr. Mikulik on 15 Primac Place.
I just gotta find it, bring it up here. Okay. Okay, we have file number 24-3804, roll number 0400725489. Roll year 2025, assessed value 7,357,000, classification 20, liability T, taxable. So we have a 2021 build of new row housing. There are 2 stories, 8 buildings, 32 suites. We can see here based on the location on page 2, it's located in the new development in the Transcona area, just north of the Costco. So just north of Regent, and it would be east of Peguis in that new development area. So again, close to a lot of amenities, good neighborhood, close to public transportation, etc. Moving to page 3, you could see our income value summary. So our average monthly rent per unit with 32 units coming out at $1,530, and there's 16 2-bedrooms and 16 3-bedrooms. When you look at how the income workup is done, our gross rents are $587, $558, 2.6% vacancy, effective gross income $572, $281. Expense ratio 39.58%, and that gets your net operating income of $345, $772, using a 4.7 cap rate. comes up with the $7,357,230,000 per unit per suite. I just provided some rental comparables here for the property, so you could see where it would fit in along the other properties that would be similar row houses. So they're not all right in the direct neighborhood, but because it is new row housing, it's harder to find maybe right in the general area. But when you look outside of it, you could see that the rents fall in line at 15, 30, 10, with Camille Sis being on the higher end, and because they're all 3 bedrooms. 860 London, 1480, but built in 1995, 18 3 bedrooms, but it's still 1480 a unit. And then 35 Jack Reimer, built in 2019 to 2021. I get like phased in with the buildings. But you could see at 1506, but they have 1 bedroom, so that will tend to pull it down slightly. So at 15, 30, 10, we feel it's still reasonable, reasonably supported with the income. Now, if you look at our capitalization rates again here on page 5, so for multifamily, you could see that we fall in between the 20th and 80th percentile, 4.75 to 5.45. We have this property at 4.75 on the lower end, but again, being it's new construction, we feel that that's still warranted. And the newer property, it's still 4.75 would fit in with the other brokers that are listed here. And further to that, page 6 would have our capitalization rate evidence just to justify that our model is okay in applying that type of capitalization rate, where we've taken these sales and we've stabilized their net operating income based on what they've historically reported to us and put it into its sale price. We could see here, being a new build, 2390 McPhillips, 4.71%, that sold in 2020. And so we're probably looking at being close to that type of cap rate based on how this subject property is. And if you look forward here to page 8, we've supplied their income statements. And so you could see that I had worked up, sorry, on page 10, that was page 10. I had done a little workup here based on what was reported by stabilizing their management to 5%, and then using 1,500 per unit for repair and maintenance to come up with a stabilized net operating income of 346,831. The model's at 345,772. So we feel that that's appropriate still based on what they're reporting to us. Now, you just on page 12 provided just pictures of it. You could see it's a new build. These were pulled from their website. So nicely landscaped, newer construction. The interior, obviously it's new. You get a basement out of it. So it's a pretty good apartment in a good location. And then I had listed a little blurb about the property being, it's about Primac Place, brand new private walk-up townhouses located in Winnipeg's Transcona community. Each suite has a private entrance, in-suite laundry, in-suite storage, large functional kitchens, abundance of closets, etc. So you are getting a little bit more offered in terms of amenities, but you're also getting a little bit more privacy, being that you're almost in your own little house. And yeah, I think at 4.7% cap rate, based on what the market evidence has provided us, that our value here is okay. And that would conclude my presentation. Thank you.
Okay, questions, Mr. Newman?
Yes, thank you. Good morning, Mr. Michalek. Nice to meet you for the first time.
Good morning.
A small number of questions. On your page 1, the construction, it references wood or steel framed exterior walls. You understand the construction here is wood frame?
Okay, yeah,
Let me say it differently. It's not concrete construction.
okay,
And concrete is always better than wood frame, correct? It's got a longer life
it would, yep,
and it's quieter.
yep.
All right. Page 3, everything on page 3 is model, correct?
Yes,
Your page 6, the capitalization rate evidence. So that we're clear, you're not suggesting any of the capitalization rates on this page are used to derive the capitalization rate for the subject, correct?
so this page, so I'll just expand on that for you. This page is used to justify the application of the model cap rate of 4.7%. So it's kind of as a way for us to say, like, if our model's saying a cap rate, we look at a range of sales to say, well, where do cap rates actually fall when we review sales? And so that's where we've use this chart to just as a supporting document in justifying that a 4.7 cap rate can be applicable in this circumstance.
And what you're really attempting to show us, I gather, through your page 6, is that this analysis gives you a range of capitalization rates for different buildings, and the subject falls within that range, and therefore it's okay.
That is correct.
Okay. But to be clear, it says at the top paragraph in the last line, the purpose for showing these capitalization rates is to illustrate the accuracy of the model and substantiate the model derived cap rates. They are not meant to be comparable specific to the subject property. And I think we acknowledge that. So when we look at this group of properties, a number of things struck me when I looked at it. The first thing that struck me is the age of these buildings, with the exception of 2390 McPhillips, which I'll come back to. Every one of these buildings was built in the 50s or 60s. Sorry, there's one in 1972. Why is it that this is the best the city can do in terms of the spectrum, the range of building sales to justify its model?
These were all the sales that we were able to gather through the period. We've combed through everything that's gone through land titles that would have any type of sales that have been reported on stable historical income. So there may have been some that have sold, but there's no data, like historical data, to go along with stabilizing their net operating income. So that's where we've come to these. Now, we aren't privy to share transfer sales, and I know there probably is quite a bit out there of new construction that would further our case, but that information doesn't get shared with us as it's a private equity transaction.
Okay, so as we've established, the great majority of these sales are of much older buildings. They're also, generally speaking, of much smaller buildings, correct?
Yes.
And similarly, the sale price on these buildings, again, generally speaking, and I recognize that 2390 McPhillips at $19 million plus was a significant price. And also Hendon at $6.8 million is significant. Everything else is much lower in price, correct?
That's correct.
And I'll suggest to you that when you've got lower value properties, you've got different buyers. It's essentially when you've got lower price buildings, it allows what I'll call entry level buyers more easier access to the marketplace. Do you agree with that?
Yep.
Okay. So the subject is 7,357,000. It's $229,000 a door. It's a higher price than any other of these sales on a per suite basis. Agreed?
That's correct.
Okay. Now, I know that there are some differences of opinion relating to 2390 McPhillips. And I don't think we're going to necessarily solve it here today, but I just want to be sure the panel has it in mind that the different and higher capitalization rates that other people are bringing forward, including Altus and other agents, they're driven by the adjustment of the net operating income based on their view that the purchaser would have the ability to increase the rents. You know that that's the case. I'm not asking you to agree, but you know that that's what they're doing to derive a higher capitalization rate. Agreed?
Yeah.
Okay. The subject property, your rents are at $1,530 a door. As between us, as the board will hear in a moment, there's not very much difference between our gross potential income or our net operating income, correct?
I believe so.
And would you also agree with me that there's a part of the marketplace that acquires apartment buildings that buys them to reposition them? And that repositioning sometimes takes its form in a rehabilitation of the units. That then allows above guideline rent increases, and it generates a higher net operating income. So there are people who do that when they acquire buildings, correct?
They can, yep.
All right. And there are other people who buy buildings where the rent structure will not be repositioned. And essentially what they're buying is a yield on their purchase price. Agreed?
Potentially.
Okay. Those are my questions. Thank you.
Okay, Ms. Knight, any questions of the assessor?
I do not, thank you.
Mr. Kraus?
No, I'm good, thank you.
Okay, you can begin your presentation then, Mr. Newman.
Thank you. And what I will do, I think it will be easiest to do it this way. I'll jump you to page 14 of my submission. And that's the spreadsheet with the analysis. And what it shows is a potential income. Are we all there? Are we all okay?
Page 14, at least my page 14 doesn't seem to have a spreadsheet.
What's the page before that?
Categorization of buildings is a heading on it.
There is a little apartment thing that says high rise, low rise, if that's what you're talking about.
No, there should be a spreadsheet associated with this.
Hmm.
No, there's a multifamily thing on page 12, but that just again doesn't show a spreadsheet.
Okay, I apologize. The gremlins have gotten in there. The
Are you
numbers
talking, are you talking about the effective year built and the Altus 2025 good location with
No.
Okay.
I've got a calculation spreadsheet at the end, which I'm holding up, which the gremlins have somehow gotten at this. If I can ask you, because the numbers are actually quite straightforward and very similar to the assessor, and what I want to do simply is illustrate the assessor and I are not that far apart on all the inputs until we get to the end, and it really becomes a cap rate issue on this property. And so if I could, because the numbers are simple, if I could just ask you to take them down.
Yeah, I believe that they're mentioned in your brief. and I have put them into my own spreadsheet, but
Yes, you're quite right. So at page, again, I think it's page 13, the conclusion section.
yeah,
Okay, so then I'll tell you that what my spreadsheet shows is potential income of $578,584. That compares to the assessor's $587,000 and change. So we're about $9,000 apart there. I've used the same vacancy, I've used the same expense ratio. My net operating income becomes $340,491. The assessors at $345,772. So we're $5,300 difference approximately on the net operating income. And the difference fundamentally is I've used the rents in place and the assessor has used the model. And I've been comfortable using the rents in place because it's a new build. And so the rents that are being reported are the market rents for this new build. So again, $5,000 apart, approximately $5,300 on the net operating income. The real issue is the capitalization rate. And the assessors got it at 4.7%. And I know I'm going to end up repeating some of what you've heard in other hearings, but let me jump to my page 3. So page 3 is a chart which compares the brokerage capitalization rates reported Q1 2021, the last assessment cycle, in other words, and Q1 2023 for the different categories of property. Now, clearly, this isn't a high rise, so in many ways we can ignore those. And I'll come in a moment to how the different brokers categorize their properties and their descriptions. I want to mention that obviously there was an increased cost of borrowing that came into play as we moved between April of 2021 and April of 2023. And on my page 4, you see a chart reflecting the increases in the Bank of Canada benchmark interest rate, which moved up by 425 basis points between April of 21 and April of 23. And we all know, and again, Mr. Harden, you made reference to it in an earlier hearing. Those of us who went to the bank and looked for a GIC rate, suddenly we could get 5%. Indeed, you could get better than 5% if you did a little bit of hunting around at certain points. I know I got 5.7% on some money, and that becomes important in the context of risk, and I'll speak more about that. But absolutely, GIC rates came up significantly by April of 2023. So commercial mortgage rates also went up. They went up by 200 and 300 basis points. That's driven, of course, by bond rates. And we see the bond rate chart on page 5 of my submission. And you can see that the Government of Canada yields have gone up. It's one of the factors, but there's no question that the borrowing of money is a very integral part of the real estate economy. Real estate investors want leverage. They want the ability to borrow and do more projects and make more investments. And so interest rates become a very important and critical element in that process. We see on page 6, again, CBRE reporting national capitalization rates. And you can see that there is a little bit of a move up as we get into 2022, and that rates do go up a little bit, and they are up compared to where they were, I'll suggest to you, in April of 2021, when the Bank of Canada rate was 0.25%. Colliers, in the middle of page 6, in their Q1 23 reports, indicates that cap rates in Winnipeg have begun to increase because of the rising rate environment consistent with other locations across Canada. There are various factors which can affect interest rates, different building types, for example, and that's why I asked the assessor about the fact that this is wood frame. Wood frame ultimately is not as good as concrete construction. It's got a shorter life. It's not as quiet. The experience of living in a wood frame building is not as good, I'll suggest, as living in a concrete building. It leads to more maintenance. It leads to higher costs. And all of that, of course, ultimately leads to higher risk. I know that Altus has reported some capitalization rate information. I referenced that at page 8 of my brief and on to page 9. I also referenced the Altus conclusions. They indicating that buildings built 2005 and more recently, the rate is in the range of 5 to 5.75%. The variables that get taken into account that are listed on page 9, those same variables are also listed by the city in their manual. And you see that at the top of page 10. So again, there's not a cookie cutter for cap rates. There's a spectrum. Different buildings will fall to different places on that spectrum. Here we have a building that's being given the very low end of the capitalization rate at 4.7%, and yet it's not the best quality building in terms of its construction, wood frame as opposed to concrete, things like that. Also amenities on site. So, and I appreciate that these are townhouses. And so, you know, if you're in a large apartment building, the trend these days is that large apartment buildings have common rooms. Frequently they have kitchens in them so you can entertain in this common or party room. They have gyms of some type. They have amenities of that type. The subject property, of course, it doesn't have a clubhouse. If it had a clubhouse, those types of amenities could be made available, but it doesn't. And so those kinds of amenities are not available. Again, placing it in the spectrum of different buildings, less good than the top quality buildings. So you see Colliers and their cap rates at high rise and low rise, 5 to 6%. Categorization of buildings at page 11, that's a bit of a repeat of what I said before. You see Cushman Wakefield at the top of page 12. They categorize low buildings as buildings with fewer than 80 units.
If I could just interrupt you here, Mr. Newman, we're getting different numbers on your pages than what you're referring to, but the pages are there.
Okay, thank you for this. I'm not sure what happened on this one, but obviously something did, and I'll look into that. So my page 12 says Cushman and Wakefield Q1 2023 at the top.
That's our page 14.
That's your page 14. What the heck is going on here? So you see that they categorize low rise as being apartment complexes with fewer than 80 units. So this would fall into low rise at a 5 to 5.75%. CBRE on the lower half of that page. Class A buildings for them are buildings that have top of the line finishes and amenities. I would suggest this building is not a Class A building because of the absence of amenities. So it's going to fall into the low rise B and at a 5 to 5.25% rate. And so really what it comes down to from my perspective in my conclusion page, which might be your page 15.
Correct.
Okay, so on my conclusion page, you've got a $5,000 difference in net operating income. The source of that is I've used the actual rents. The assessor has used a model, not a huge swing, obviously. The issue is the capitalization rate, and I'm asking for a value of $6,809,000 compared to the assessor's 7,357,000. And it's driven by that increase in the capitalization rate to 5%, generated by what I say is the difference in quality of the building. And it's not in that top grade quality, and it's consistent with the broker rates established. So subject to questions, that's my submission.
Okay, questions, Mr. McCulloch?
Yeah, so on page 3, it is listed that you have the table that summarizes contained market reports. And so you could see on the right-hand side the change low and high. CBR, like Collier's 0% and 0%. CBRE's gone down negative 0.75 and negative 0.5. CBRE High Rise B, negative 0.5, negative 0.25. So the only one here is Cushman had said high rise is 0.25% from 2021 to 2023. And then yet on page 4, it's being classified that this tie-in with the cost of borrowing money, but based on the information that these brokers have presented, is it really is that really tying into cap rates going up if they're saying they've gone down?
So I think the answer is that, and you're focused on the right-hand column, the change column. I think you also have to look at the categorization of the buildings and what category does it fall into, as I suggested to you earlier, and it will depend on the brokers. So yes, they say it's gone down a bit in certain circumstances. From my perspective, what I'm most interested in is putting it in the right place on the spectrum. And in my mind, the right place on the spectrum is not 4.7%, it's 5%. And I think the broker's rates are, in a general sense, consistent with that.
Now, just touching on, could you agree that in an environment where interest rates have gone up, that it is harder for new buyers entering the market to buy a residential home? Can you agree that they can't get as much money?
In a general sense, I would agree it can be harder for home purchasers where interest rates go up to be able to afford to purchase a home.
So could you also agree then that can drive those new home buyers to have to rent apartments?
To some extent, it can.
Okay. And then just with regarding rents, could you agree that being this is a new build, you're exempt from rent controls for 20 years?
That's true, but you're not exempt from market control. And so ultimately, the question is, what will the market allow you to charge? And the reality is, including up to 2023, because projects were in process already, there's been so much new apartment construction in Winnipeg over the last number of years. And again, a lot of that was planned before interest rates started to move. So I think there's going to be a shakeout in due course because of all that new capacity, all the new supply that's come into the market. And the shakeout will reveal itself in 2 ways: an increase in vacancy rates, but it's also going to put downward pressure on rental rates. But having said that, again, we're not really fighting much about the gross potential income here. That's not our issue.
I guess the way that I was trying to point that to is the fact that you're going to have more demand for renters, being that it is a higher interest rate environment, that you have more of a quality of an income stream and you're not as concerned towards vacancy. Other than that, that is all my questions. Thank you.
Okay, Mr. Kraus, any questions?
No, good, thank you.
Ms. Knight, any questions?
No, thank you.
All right, and I have no questions either. So, does either party wish a summation? Mr. McCulloch?
No summation necessary. Thank you.
Mr. Newman?
I'm good. You have my points. Thank you.
Okay, thank you very much for your presentations. We have now heard all items on the agenda and this hearing is now closed. So thank you very much for everybody's presentations today.
Thank you.
Good morning, all.
Thank you.
Good morning. All right, we'll just have a very quick break and then we'll get down to our deliberations.